As we move into 2026, one insight is becoming increasingly clear to property investors. The gap between short-term and long-term rental performance is widening. Airbnb can still deliver outsized returns, often generating a full month of income in a single peak week, but those gains come with elevated volatility driven by tourism cycles, cancellation risk, and significantly higher operational overhead. Long-term rentals, meanwhile, offer lower revenue peaks, yet provide something the current market rewards more than ever: durable cash flow and reduced exposure to occupancy shocks. Choosing between the two without understanding their underlying risk profiles can lock investors into unstable earnings or recurring maintenance drag. But when you identify the economic forces shaping each model, you can position your property for stronger, more predictable performance in the year ahead. Let's break down the real dynamics driving this divergence. The central challenge investors face entering 2026 is not simply choosing between Airbnb and long-term rentals. It is understanding how each model responds to a market environment defined by fluctuating demand patterns, tighter regulations, and rising operating costs. The core issue is that the income streams generated by these two strategies behave very differently under economic stress. Short-term rentals thrive on transient, discretionary travel demand, while long-term rentals rely on the far more stable foundation of housing necessity. This divergence affects several investor groups simultaneously: new landlords seeking high cash-on-cash returns, existing owners considering a conversion to short-term use, and investors dependent on rental income to service debt. All three groups face the same exposure: unpredictability. When occupancy becomes volatile or revenue varies sharply from month to month, cash flow planning becomes more difficult, increasing financial pressure and reducing resilience. The consequences of ignoring these shifts can be significant. An Airbnb property that performs well during peak tourism may experience yield compression during off-season months, leaving investors with sporadic income that may not align with mortgage obligations or long-term financial commitments. Conversely, long-term rentals that provide reliable monthly income can still generate risk when screening is rushed or when compliance requirements are misunderstood. What makes 2026 especially important is the tightening regulatory landscape in many cities. Several jurisdictions are introducing caps, licensing requirements, or restrictions on short-term letting, measures designed to preserve housing supply and stabilize local rental markets. These policies directly influence revenue potential and can eliminate Airbnb as an option for certain properties altogether. For these reasons, the question investors must answer is not which model makes more money, but rather which model aligns with my risk tolerance, operational capacity, and market conditions. To answer that, we first need to dissect the underlying numbers and operational dynamics that separate these two approaches. A closer look at the underlying data reveals why Airbnb and long-term rentals diverge so sharply in both performance and predictability. One of the most consequential figures is the income differential. In many tourism-driven markets, a short-term rental can generate in a single high-demand week what the same property would produce in an entire month under a traditional lease. This reflects not only the premium pricing of nightly stays but also the elasticity of travel demand. Guests are willing to pay more for convenience, flexibility, and location-specific experiences. The implication is straightforward. Airbnb income is highly sensitive to occupancy swings and therefore structurally volatile. Seasonality further amplifies this effect. Tourism cycles dictate occupancy levels, meaning revenue can fluctuate sharply between peak and off-peak periods. Even temporary shifts, weather disruptions, slow travel months, business travel downturns, or unforeseen global events can reduce occupancy to zero, producing what investors refer to as income cliffs. This dynamic is amplified by cancellation risk. When a guest cancels close to the arrival date, rebooking windows shrink and the property often sits empty. In operational terms, each cancellation represents lost revenue that cannot be recovered. Wear and tear metrics also matter. Short-term rentals experience substantially higher turnover, accelerating depreciation on furniture, fixtures, flooring, and appliances. This leads to more frequent replacements, increased cleaning cycles, and higher ongoing maintenance expenses. While these costs rarely appear in headline revenue figures, they reduce net yield materially and should be treated as an operational drag. On the long-term side, the numbers tell a different story. Tenancy agreements typically span 6 months or longer, producing consistent revenue and minimizing turnover-related expenses. Once tenant screening is completed, credit checks, employment verification, and rental history review, income becomes far more predictable. Void periods still occur, but their duration is significantly shorter and less frequent compared to short-term stays, allowing landlords to budget with greater confidence. Legal and compliance requirements form another critical data point. Long-term rentals must meet safety regulations, right-to-rent checks, and other statutory obligations. Though these add administrative work, they create a more structured operating environment. Mortgage terms also play a major role. Many lenders restrict or prohibit short-term letting without explicit consent, and violating these terms can result in fees or even demands for loan repayment. This risk disproportionately affects Airbnb operators. When these data points are viewed together, a clear pattern emerges. Airbnb income is high variance, high maintenance, and demand sensitive, whereas long-term rental income is lower variance, lower maintenance, and regulation structured. Understanding this distinction is essential before interpreting what these numbers actually mean for investor strategy going into 2026. Interpreting the data through an investment lens reveals why short-term and long-term rentals behave so differently and why their performance gap is widening entering 2026. The strong weekly earning potential of Airbnb is not simply a sign of profitability. It reflects a model built on discretionary travel demand. Travelers pay a premium because their stay is optional, time-sensitive, and experience-driven. But that same demand is inherently unstable. When tourism slows, when weather shifts, or when global events disrupt mobility, revenue drops immediately. This is why short-term rental income resembles a high beta asset, capable of outperforming during strong periods, but equally vulnerable during downturns. Seasonality exposes the second structural issue: yield inconsistency. If a property earns disproportionately during a few peak weeks, the investor becomes dependent on those windows to justify the model. Any disturbance, fewer bookings, later seasonal peaks, or increased competition compresses yield. This is fundamentally different from long-term rentals, where revenue derives from a tenant's ongoing housing need, producing what analysts call cash flow durability. Housing demand rarely moves in sharp cycles, making long-term rent less sensitive to external shocks. Maintenance dynamics offer further insight. High guest turnover accelerates depreciation and raises the operational burden. Cleaning resets, item replacements, guest communication, and resolution of minor damages all accumulate into what professionals refer to as operational drag. Airbnb can outperform only when operational drag is tightly managed, often requiring near-professional hospitality infrastructure. Investors who view Airbnb as passive income are often surprised when their net yields shrink after accounting for time and maintenance. The regulatory landscape adds another dimension. Many cities entering 2026 are tightening control over short-term rentals through licensing caps, zoning restrictions, or night limits. These measures reflect broader housing supply concerns and political pressure to protect long-term affordability for residents. As these rules expand, they directly affect revenue potential and may eliminate the viability of Airbnb for certain properties altogether. Long-term rentals, in contrast, operate within a stable regulatory framework that has remained relatively consistent for years. That stability translates into clear expectations for both landlords and tenants. Another factor that investors often overlook is mortgage compliance risk. Many lenders prohibit or restrict short-term letting without explicit approval. A landlord who unknowingly violates those terms can face penalties or even demands for accelerated repayment. This risk rarely exists on the long-term side, where tenancy agreements fit naturally within standard mortgage structures. The psychological dimension also matters. Short-term rentals create constant demand for attention. New guests, new messages, new turnovers, new expectations. Long-term rentals, by contrast, create continuity. A reliable tenant becomes a predictable relationship, and predictable relationships create predictable cash flow. Investors often underestimate how much this stability contributes to long-term financial planning. Common misconceptions further complicate decisions. The most widespread is the assumption that higher nightly rates automatically equal higher profitability. Gross revenue is irrelevant without factoring in vacancy, wear and tear, cleaning, and platform fees. Another misconception is that long-term rentals require minimal involvement. While they are far lower maintenance than Airbnb, they still require proper screening, documentation, and periodic oversight. When these factors are evaluated together, the conclusion becomes clear. Airbnb behaves like a higher-risk, higher-variance asset class, while long-term rentals behave like a stable income vehicle. Neither is inherently better. They are simply built for different investor profiles and market conditions. The next step is translating these insights into actionable strategies for 2026. Translating the analytical insights into a practical 2026 strategy begins with clarifying the type of income your property needs to produce. For investors considering Airbnb, the first actionable step is an honest assessment of location-driven demand. Short-term rentals only outperform when the surrounding market generates consistent travel activity across multiple seasons. If your property sits near business districts, universities, major attractions, or year-round tourism corridors, the short-term model becomes structurally more viable. The second step is operational readiness. Investing in durable furnishings, standardized cleaning processes, and clear guest communication protocols. These reduce maintenance drag and protect net yields. The third is building vacancy buffers, setting aside reserves to absorb seasonal dips or sudden cancellations. For landlords leaning toward long-term rentals, the priorities are different. The most critical action is tightening tenant screening, verifying employment stability, checking credit, and reviewing rental history. A well-selected tenant dramatically reduces payment risk and turnover costs. Next, landlords should schedule all safety inspections and compliance checks up front. This not only ensures legal alignment, but also reduces friction throughout the tenancy. Long-term investors should also evaluate the feasibility of small capital improvements, fresh paint, updated fixtures, or enhanced curb appeal, because these upgrades support a stronger rent positioning without requiring continuous operational input. Each model carries conditions. Short-term rentals require time, responsiveness, and tolerance for occupancy volatility. Without these, the model struggles. Long-term rentals require patience and acceptance of slower revenue growth, but they reward consistency, stability, and lower risk exposure. The benefits of aligning your actions with your chosen model are substantial. A well-run Airbnb can outperform dramatically during high-demand periods, improving cash-on-cash return and accelerating capital recovery. A well-structured long-term rental, by contrast, creates a predictable financial foundation that supports debt planning, long-term budgeting, and portfolio scaling. Both are valid wealth-building tools when executed with discipline. However, investors must avoid several common missteps. The most frequent error is evaluating Airbnb based on gross revenue rather than net yield. Cleaning fees, maintenance, guest turnover, and platform commissions materially reduce profitability. The second mistake is underestimating the administrative burden of long-term rentals. Screening tenants poorly or neglecting compliance can lead to costly disputes. A third mistake, often overlooked, is ignoring mortgage constraints. Running a short-term rental without lender approval can trigger penalties far exceeding any rental profit. For more advanced investors, 2 strategic enhancements are worth considering. First is a hybrid occupancy model, operating as a long-term rental during slower quarters and switching to short-term during tourism peaks. This approach requires precise calendar management but can stabilize yield while capturing upside. Second is outsourcing operations for Airbnb. Professional cleaning teams and guest management services reduce operational drag and protect rating scores, which directly influence occupancy and pricing power. These practical steps transform the high-level comparison into an actionable framework for 2026. Next, we must examine the risks and misconceptions that can quietly undermine even the most well-planned strategy. Even with a well-defined rental strategy, several risks can materially undermine performance if investors are not careful. For short-term rentals, the most significant vulnerability is income volatility. Many landlords project annual returns based on strong peak season performance, only to discover that occupancy collapses during off-season months. Without sufficient cash reserves, this volatility can create liquidity stress, especially for investors servicing debt. Another major risk is operational fatigue. High turnover means more guest coordination, rapid cleaning cycles, and frequent minor repairs. Over time, this erodes both profitability and investor bandwidth, particularly for those treating Airbnb as a passive investment vehicle. Long-term rentals carry a different set of risks. The most consequential is tenant misalignment. Selecting a tenant without thorough screening, credit checks, employment verification, landlord references, can lead to payment inconsistencies or extended vacancy during eviction processes. Additionally, misunderstandings about compliance requirements, such as safety inspections or right-to-rent checks, can result in fines or administrative complications that offset the financial stability long-term rentals typically provide. Several misconceptions also distort investor expectations. The first is assuming that higher nightly rates guarantee higher profit. Gross revenue is not net yield. Cleaning, maintenance, and vacancy materially impact returns. The second misconception is believing long-term rentals require minimal oversight. While lower maintenance than Airbnb, they still demand structured documentation, tenant communication, and periodic inspections. A third misconception relates to mortgage constraints. Many investors overlook the fact that lenders often restrict or prohibit short-term letting. Violating these terms can trigger penalties that far exceed any rental income. There are also regulatory limits worth noting. Many cities are tightening short-term rental rules for 2026, introducing permit caps, zoning restrictions, or limits on allowable rental nights. These policies can drastically reshape revenue potential and, in some markets, eliminate Airbnb as a viable option altogether. To mitigate these risks, investors should document all transactions, screen tenants rigorously, calculate true net yield, and verify lending terms before selecting a rental model. With these risks clarified, we can now step into the broader conclusion: how each strategy ultimately aligns with investor priorities for 2026. When viewed through the lens of risk, operational demands, and income durability, the distinction between Airbnb and long-term rentals becomes clear. Short-term rentals behave like a high-variance asset class, capable of delivering exceptional returns but equally capable of producing extended periods of underperformance when demand softens or regulations tighten. Long-term rentals, by contrast, function as a stable income vehicle, offering predictable cash flow and far lower exposure to occupancy shocks. Neither strategy is universally superior. Each succeeds when matched with the right investor profile, market conditions, and operational capacity. The value of this analysis is not in choosing one model over the other, but in selecting the approach that aligns with your financial resilience and the demands of your specific property. Investors who understand these dynamics enter 2026 with a clearer path toward consistent, strategic growth rather than reactive decision-making. So here's the question: Which risk profile aligns more closely with your goals for 2026? The high upside volatility of short-term rentals or the stable cash flow model of long-term tenants? If you'd like deeper insight into hybrid strategies or city-specific regulatory trends, feel free to ask.